Welcome back to another exciting lesson. So today we're going to talk about something super exciting called options, okay? And we're just going to kind of go over the basics, and that's about it, because these things can get out of control if we get too much into it, okay? So let's go ahead and get started, and at the end you guys can tell me, if you want like a further explanation or something more in depth, okay? So what actually is an option? So it's a derivative product. Now, the first time I heard of derivative, I thought of math class, like calculus, vectors, derivatives. So guys, don't even worry. It's nothing like that. Pricing these things is much, much harder. It's way harder to price these things, but we're not going to go into that. Luckily, we don't have to price these things. We don't even need to know how they're the nitty gritty of how they're priced. We just need to go into them. Fun fact, if you are actually interested in learning how to price these things, just look up the Black-Scholes formula. And if you actually can get through it without needing any help or anything like that, you might want to actually change careers to that, because it's pretty crazy stuff. So it's called a derivative because it derives its value from the underlying. In this case, the underlying are stocks and usually ETFs. So we're going to be talking about options in terms of options, equity options, okay? Stock options, as you guys call them. So what actually goes into them, it's not like a stock where you just look at price up and down. You're looking at the time value, because it has an expiration date, and the volatility, the implied volatility, and also interest rate in the environment, okay? So why are we actually buying or selling options? Why are we trading options? What's the whole point? The reason is that you can leverage or explode your gains. Of course, you can leverage or explode your losses as well, so be careful. You can make more with less, okay? So why is that? Because one option represents 100 shares. So one contract, when you're purchasing one contract, you're really representing kind of the price action of 100 shares, okay? And you're not paying for those 100 shares. Well, not yet anyway. We'll go into that later. You're looking at, if you're buying, you're actually purchasing the premium, okay? And if you're selling, you're collecting the premium. So in options, it's more to it than actually just buying and selling. There's 4 positions that you can take and 100 different strategies, usually going up to 4 legs, which means 4 different option strategy contracts in one, okay? So we're actually an option, we call them calls and puts, okay? So the 4 positions, we don't really talk about buy and sell, we talk long and short instead, just to not get confused, right? Because in stocks, you can say buy and sell because it's just one thing in question. If you're looking at an option chain, right, you're looking at calls and puts side, okay? Calls are, if you're buying a call, you're considered bullish or long, and if you're buying a put, you're considered a bear, okay? You want to make money on prices going down usually, okay? Now, if you're selling a call, you are going to be the opposite of buying a call, right? You're the person that is providing the call option to the other person, okay? So then you would be, instead of bullish, you'd be bearish, but more likely you're neutral, okay? So you don't really care where it goes. It can stay the same or down. You're not necessarily hoping it goes down. It just so happens if it's down or staying around the same, you'll collect your premium. With a put, it's the opposite. You're hoping it's staying the same or going up, okay? So let's go into the call side. I'll explain calls, and then puts are literally the same thing. It's just the opposite way. So the buyer of a call is called a long or bullish. Okay, so when you buy a call, you have the right but not the obligation to purchase the shares at the strike price, okay? What does that mean? When you're purchasing a call, okay, as are doing this along with me, at your brokerage, you'll see that instead of just buying and setting the price, you have to set the expiry date, okay, the position, the call, and the amount of contracts, okay? So when you're buying the contracts, you have to remember that you're trading these in 1, 2, 3, 4 contracts, because that's 100, 200, 300, 400 shares. So I'm putting 100 options, 100 contracts of a call, okay? Unless you're actually looking to bet on the price movement of pretty much 10,000 shares. All right. The seller, so in this situation, whoever is buying the call is paying the premium to the short or the bear. Okay. So what that person is doing is the seller is giving away the rights to their shares for a premium that you're paying them. So the seller actually gets money right away, regardless of what happens. Okay. What he's hoping is he can stay. The premium he collected stays with him. The bull is hoping that the price action is going to go up so high above where he bet that it's going to go, the strike price, okay, or the price it is right now. Generally, if it's we have in the money, out the money, but we'll talk about that at a different time. And the buyer, what happens is he has the right, not the obligation, to exercise the contract's terms. So what does all this mean? When you're buying something, you're choosing the strike price. So let's say $55, okay? And you're saying it'll hit $55 by, let's say it's March 2021. It'll hit it by June, okay? So if it doesn't hit it there, you're not going to exercise your contract. You're going to let it expire, because there is no point in you wanting to buy those shares for more than they're worth, right? So if you're not, like, if you're betting the strike price will be $55, it's going to be $53. There's no logical reason for you to exercise buying 100, 200, 300 shares at $55 when they're trading at $53 in the market, okay? So let's go into the example here. So when you're buying an option, there is a strike and expiry date. So let's say I'm the buyer of the call. I want to purchase one call option with a strike price of $55, expiring 3 months from now. Now, the way that you can actually pick the dates is that, well, really it'll give you the option chain, okay? So if it's something like a month away, you'll see that you can buy them a week out, 2 weeks out, 3 weeks out, okay, on certain securities. If they're 4 or 5 months out, you have to purchase them in cycles and quarters, okay? So it's not like you can just choose an arbitrary date, August 17th, for example, and it won't necessarily be there, okay? So you do have to play within the confines of the limits that you're given, okay? So right now, let's say the stock is $50. You're purchasing a call option with a strike price of $55, and you're paying $1 in premium. So basically $100 leaves your account. Okay. So in a month's time, if the strike price hits $55, okay, and you don't want to exercise the shares, you just want to sell it, okay, then you have made 55 minus 50, which is $5 in profit, less the $1 in premium that you made. And remember, a contract is 100 shares, so you have to multiply this all by 100. So first we just do some rudimentary math. 55 minus 50 is $5 in profit. You paid $1 for the premium, so your total profit is 4. Then we multiply by the amount of contracts that we made. In this case, it's one contract. One contract is 100 shares, so your total profit is $400, and all that you have invested is $100, okay? And whereas if you wanted to make the exact same price movement, okay, with your stocks, you would have to purchase 100 shares at $50 per share, and then wait for it to go up to $55 and sell it. You'd make $500 in profit with 50 times 100, right? So $5,000 you'd have to spend to make the just a little bit more money. So in this case, you can see why options could be very valuable, because you can make a lot with a little bit, and you can also use your different strategies to hedge. Okay, so what's very important about the scenario is that unlike stocks, where everyone can win, right? Options are called a zero-sum game. So what does that mean? There is a clear winner and a clear loser. Okay, so a stock, okay, let's say I buy it at $10, I wait for it to go to 20, I sell it to you, okay, I make $10 per share. You purchase it from me at $20. In another 5 years, it goes to 30. You sell it at 30 to the next person, and so forth. If that stock keeps going up, I made $10 per. I made that price difference you made that price difference. So I don't know how many shares you bought. So right, I made that price difference of $10 per, however many shares we purchased. You made the $10 between that price that we purchased at. So now we have that money and we both won. We had to wait a long time, but we both won. But here, in that scenario, the seller, previous scenario, the seller would lose their shares, but keep only the premium. So, they will have $100. It'll kind of offset a little bit. If the stocks that they got at, let's say $45 and they lost them at 50 when it was actually 55, then they still would have made the money. It's just they have the opportunity cost that they can't make more money. Okay, so let's look at the scenario if we actually were wrong and the stock goes to $45 instead of 50. Okay, you would actually let the contract expire and you would lose the $100 premium. Their shares would also be fine with them. Okay, so it's important to remember that in these contracts, if you're the seller, if you're selling a call, you are giving up the right to your shares. So if the other person exercises it, he can get the shares for you at whatever price was deemed. Okay, so if your strike price, for example, let's do another aggressive one. If your strike price was $55, stock goes to 70. If they exercise that, then they will get all your shares, right? All 100 of your shares at whatever the strike price was, $55, instead of buying it from the market at 75, right? So you lose the opportunity of that $20 between 55 and 75 as the seller, rather than selling them on the open market. You just took the bet that you could keep your shares plus the $100 in premium. Okay, so it's also important to remember that not everyone exercises their contracts, but you would still lose. Some people roll them out. Okay, so what that means is they open up a new further position. They would take their profits and take on a new position, or they can just go ahead and sell the remainder of the contract if it has some time left into it, right? What do we say, June? If it's now April, they can actually sell it to someone else. The time value will have gone down, so they will make less money on that because the closer it is to expiry, the less volatility it has, right? The less chance that it'll move up or move down depending on where it's at. While the person that is selling would just keep the premium. All right. So you do have to remember that you can actually just sell the contract instead and take your profits rather than having to exercise, buy it, and get it to you. So this is where if you guys have ever heard of covered calls as opposed to a naked call, right? This is where it would come into play here. So I'll explain that on this slide here. So first of all, puts are the same as calls, but they're in reverse. The buyer hopes to make money off the declining price, and the seller is neutral or bullish. So the seller is hoping that the price is going up or staying the same and collecting the premium. The buyer of the put is hoping that the stock price goes down so that they can in turn sell it to the put seller, sell it to the put seller, and make the money back. Okay, so a lot of strategies exist. We'll go over two. So I mentioned the covered call. A covered call is when you are selling a call with shares that you already own. This is a very good strategy if you know what you're doing to make some extra income off shares that are just sitting there. If you have 1,000 shares of a largely traded stock, you don't want to sell it, you love it, you're collecting a dividend as well, you want to make a little bit more income, you can actually do a covered call for 10 contracts and make money off that premium selling it, and hoping it doesn't go up too much, right? Because again, the person, it's not that it goes up or not, it's if the person hits their strike price or not. If they paid more premium than the price has gone up, even if it's gone up like $1 and they pay $2.50 in premium, they're not going to exercise that, right? So you just need to look at where the buyer is in an advantageous position. automatically what the broker does is it exercises them if the buyer doesn't say anything. If it's in the money, so in the money means that it hit the strike price, well, over the strike price. If it's in the money by 1 cent, so let's say the strike price was 55, it's 55.01, you're gonna get called, okay? So you're gonna get exercised on and you lose your shares, all right? There's also a married put. So a married put is not extra money. This is a hedge, okay? So this is usually what you want to do if you have a very volatile stock that goes up and up and up, but you're just very nervous of it clambering down. What you can do is called a married put. So this is not an option strategy. This is an option and a stock strategy. So what this means is if we have a stock at 80 bucks, right? It went to 100. You would then buy a put, let's say at $95 with the strike price at $95. You pay the premium, kind of like an insurance. It's like an insurance because if the stock price, you hit it at 100, but then it goes at 90. What you're doing when you're buying a put is you have the right but not the obligation to sell at the strike price. Okay, so you can see how this is beneficial. If I buy a stock at 80, it then goes to 100. I buy a put at 95. Okay, I'm basically locking in that I can sell it at 95 even if this thing comes crashing down. Okay, and all I did was pay the insurance premium. Okay, so a married put, what it does is it doesn't guarantee you more money, it just guarantees you kind of like a peace of mind. So this is why I compare it to an insurance premium. Okay, so if you knock on wood, get into a crash or your house, your insurance premium is there to give you all, if not some of the money. Okay, so to summarize, options, it gives you the opportunity to make more with less, but also you can hedge your risks. There's also arbitrage. It's a derivative product, okay, which means it derives its value from the underlying. So it's like, I can give you guys an analogy. It's like a horse race. Okay, the stock is the horse. The option is the bet on the horse. Okay, where you don't have to feed the horse. You're just kind of gambling that horse will be first or last. Okay. They're priced from implied volatility, time, and the underlying stock. Calls and puts are contracts between the parties. Okay, so it's a binding contract. The person purchasing is paying a premium to be a call or a put holder. So it gives them the right and not the obligation to buy or sell stock at the strike price. The seller is taking increased risk, but is receiving premium for that risk. There is a zero-sum game. The buyer or the seller will win. There is no one side wins, one side loses. There's no one side wins and the other side wins. There's no win-win. It's you have a clear winner and clear loser. And there are many different strategies. Okay, so if you guys do want, I can go over some more of the strategies, or if this video didn't make sense, I can make a follow-up one. Options are incredibly difficult to predict and to learn. So I don't blame anyone if they're scratching their head. Please rewind the video, rewatch it, ask me questions, and ask me to clarify anything that I haven't gone through. There's a lot to explore. All right. So I hope that makes your trading a little bit easier. Hope it makes your knowledge a little bit more. And please don't forget to like, comment, and subscribe. And finally, there is now a Discord server where we talk about these things: trading, money management, investing, and what have you. So I have that in the description or the comments below. So make sure to check that out. It's free to join and be part of our community. Okay. Thank you everyone for watching. Enjoy yourselves and have a great day.